Good morning to all of you from Brussels. It's a great pleasure to welcome and opening this new session about the virtual presentation of the publication of the fact book. Our community is built around common knowledge, common sharing best practices, and I would say the entire covered bond community is built around one book, which is the fact book. This year with Edo, we have selected, and Sasha, a nice cover, which is a puzzle of different pieces putting together for a more harmonized landscape. This is what is happening exactly in the covered bond space, where after years of discussion, of sharing ideas, of finding compromise, the community has been able to find the right compromise, the right balance between national specificities, but also a common overarching framework. This effort of working together, of building a common framework has been crowned, I would say, with the Covered Bond Directive. And the Covered Bond Directive is giving added value, providing an harmonized landscape to investors, but at the same time maintaining that national touch, which makes the covered bond rooted in the culture, in the financial culture of the different markets. The link between financial markets and real economy. That is the importance, the strategic importance of the covered bond asset classes. As a representative of the European Mortgage Federation, the European Covered Bond Council, I would like to express our deepest gratitude to more than 90 experts that have been working for the publication of the fact book, to Sasha and to Joost, who have been doing an excellent work in cooperating and putting together such an important level of knowledge, which is updated every year. So investors can find on their desk an hard copy, helping them in disclosing and finding all the qualitative element of every legislation, but also the quantitative landscape. This combination between quality in terms of quantitative and qualitative database is the essence of the fact book. Together with the fact book, we should not forget that we have also the Covered Bond label website, providing very detailed information on more than 175 cover pools, providing information about cover asset liabilities for more than 5,600 ISINs, but in total providing a very harmonized landscape with a clear European flag for the premium cover bonds for more than 2,280,000 cover bond outstanding. This is a fantastic achievement of a community that has been working together for more than 20 years to provide a solid asset class to secure the financial stability of our system. Now more than ever, with high interest rate, with high inflation, we need a solid asset class to make the capital markets union and the banking union more robust. Thank you for being with us this morning. It's my pleasure to give the floor to the two chairpersons who have been running the show and managing the publication of the fact book. Sasha, allow me to give you the floor. Thank you again to all of you for being with us this morning.
Thanks, Luca, and good morning, everybody. Also from my side, my name is Sasha Kulik from the BDP, and I'm the chairman of the ECBC Fact Book Working Group, as Luca already mentioned. We are not having this virtual publication event for the first time. We've had it several years, and well, every year we have this event. We are facing an additional crisis event. First, we had the COVID pandemic, then the war in the Ukraine hit the world, and now we have the geopolitical tensions in the Middle East. And you might even call it a war already, or we might facing a new war. And against this background, it's actually very difficult to make business as usual. And I would like to take this opportunity to say that my thoughts, and I guess our thoughts, are especially with the civilians in the Middle East. Nevertheless, apart from these geopolitical tensions, as Luca already mentioned, we are facing a complete different interest rate environment. Rates have increased in the speed and to a level that we haven't seen for ages, or maybe haven't seen ever before. And of course, this changing environment is reflected in this year's fact book as well. And we will be dealing with that new interest rate environment and what the impact on covered bonds will be in the first panel of this event today. This is just one example that this year's Factbook again addresses the most important topics. And of course, sustainable finance plays a huge role as well here. We have in this year's Factbook actually 5 dedicated articles on that subject, and therefore it's probably not a surprise that the second panel today will talk about sustainable finance. Another very important topic we have been dealing with over the last few years, and that will keep us busy over the next years as well, is of course the Covered Bond Directive and its transposition into national laws. It will keep us busy, the whole covered bond industry, looking at from the Commission to the European Banking Authority, and this also comprises the potential third country equivalents, and both topics will be discussed in the first panel as well. So we are again covering in the Factbook all the key themes that are extremely important, but the Factbook provides much more detailed explanation, for instance, of the covered bond fundamentals in the generic section. Very interesting articles here. And we have now an overview of legislations, of covered bond legislations in markets in 44 different countries. And finally, the Covered Bond Factbook provides an overview of the rating agency's methodology for covered bonds, which is also very important and interesting. And of course, it provides a complete set of covered bond statistics. So with that, we now have the 18th edition of the Covered Bond Factbook, and the Factbook, I guess you agree, has long become the reference book of the covered bond world. It has been a huge honor to work together with so many covered bond experts. I think for the first time this year, we have a link between hardcover Factbook and the virtual world. For instance, you find many articles having at the end of the article a QR code. You probably can't see it right now, but have a look at the Factbook. You will find many QR codes, for instance, a link to the comparative database of the ECBC. So we are now merging the virtual world with the hardcover world. We are having 6 authors of today's we are having 6 authors of this year's Factbook today with us. They are giving you an overview of what is part of the Covered Bond Factbook and what will keep us busy this year. And on top of that, we have, of course, Joost from ABN, chair of the ECBC Statistical Working Group, as Luca already mentioned. The Factbook, of course, will be nothing without figures. Before I hand over to Joost, I just would like to emphasize, please feel free to step in whenever you have a question during the 2 panels we are having this time. You can use the chat function, I guess. I will have a look at it, and Stefano, as the moderator of the second panel, probably as well. So raise your questions, make your comments, whatever you want to ask. We will try to get a lively discussion as good as it's possible in a virtual event. So now it's time for Joost to thrill us with your figures, and I talk to you later in the first panel. Thanks very much.
Yeah, thank you, Sasha, and completely be with you with all the words you said. And I'm Joost Beaumont, for the ones who don't know me yet. The chairman of the Statistics and Data Working Group for the ECBC, and in daily life head of bank research at ABN AMRO. And yeah, I can only stress also the importance of the data sets that the Factbook provides, and of course you can also download the whole Excel file at the ECBC website. And then you get a very comprehensive and complete data set, I must say, that starts in 2003 with a lot of breakdowns. And I think it's the best data set there is about covered bonds. So feel free to download and play around with it. Today I will highlight a bit the results of this year's exercise, which is about the outstanding volumes and issuance in 2022. Now, maybe some of you are already making plans for the end of the year already, so it's a bit looking back, but I think still important and also stresses actually the importance of covered bonds as a bank funding tool. Maybe if we go to the first slide that you can see on the screen. Yeah, last year we reached a new record high in terms of the volume of outstanding covered bonds. So some champagne bottles have popped open. More than 3 trillion covered bonds are outstanding across the globe, which was the first time ever that we reached this level, and that was on the back of 90 billion increase in the amount of outstanding covered bonds, and it was the 5th consecutive year of growth. And growth actually tripled last year, from almost tripled from 1.1% in 21 to 3.1% last year. And in total, there are now 334 issuers on this planet that issue covered bonds, and that is also a much higher amount. We come back to a bit the regional split later. But zooming in on the next slide, on the split between the different types of covered bonds, you can clearly see that the covered bonds backed by mortgages are the ones that mainly took care of the increase in the outstanding amounts, plus 154 billion last year, which took the total to 2.7 trillion. That's a record high for mortgage covered bonds. Unfortunately, public sector covered bonds, the outstanding amount dropped a little bit by 9 billion, and it's now 277 billion outstanding, which is actually a record low. So it's not all good news, but still, yeah, it shows the covered bonds as a finance tool for mortgages. 90% of covered bonds are backed by mortgages at the moment. Which stresses the importance it has. Maybe moving on to I think the different countries that issue covered bonds. It's always the top 10. It remains relatively stable, and the top 3 actually rather stable every year, with Denmark, a very large domestic currency driven covered bond market, with more than 460 billion of covered bonds outstanding at the end of 2022, and they are number 1, followed by Germany and France, and Spain comes as 3rd. So there's not some changes within the top 10, but not too dramatic. I would say it's quite a stable picture. And to the right, you see the sustainable covered bonds outstanding, and here it's also good to mention that the covered bonds are a good product, of course, to finance also the energy transition. There's still a lot of work that needs to be done with the Energy Performance Building Directive also coming up. A lot of existing residential real estate and also commercial real estate needs to be improved to make them more energy efficient. Well, covered bonds are a perfect tool to finance, and green covered bonds can and will be discussed later in the panels, but can be a great tool to finance this transition. If you look at issuance of sustainable covered bonds in all currencies, actually it reached almost 80 billion last year, which was up from which was a 19 billion increase actually, and it's quite a strong increase, as you can see at the graph from what it was a few years ago. So it's definitely a market that is gaining importance. The growth rate was 44%, but if you look the sustainable covered bonds as the share of the outstanding covered bonds, it's still only 3%, so it remains a niche, but the share will definitely grow. And now I'm happy to hear also all the what panelists have to say about this market, and I hope they underline the view that it will become more important. Also, a lot of new, I think 65 issuers did issue sustainable cover bonds by the end of 2022, with 50 new issuers joining. So definitely a market that's growing. At the moment, my figures show a bit of more than 100 billion of sustainable cover bonds outstanding. So definitely here we will see a further growth in the next year's exercise. Maybe looking to some other breakdowns which might be interesting to see. That is the regional split. Now, as you can see, this graph shows if you go back to 2003, cover bonds were purely a European product, driven by European issuers. But as you can see now, 88% of issuers come from Europe, with almost 8% coming from the Asia Pacific region, 3% from Canada, and 1% from South America. So here you clearly see that cover bonds are becoming an increasingly global product. The ECB also has a global issue working group which looks in more detail to the globalization of cover bonds. But the statistics clearly show cover bonds becoming more and more a global product, and we have now 34 countries where cover bonds are being issued. That compares, for instance, to 14 countries 20 years ago. So clearly growth here. And if you look at individual countries, actually Canadian market grew by 30 billion last year, and Australia, Austria, Netherlands, France, Switzerland saw an increase in their cover bonds outstanding by more than 10 billion. So also markets are growing quickly. Maybe speeding up a little bit, going to the issuance data. Well, also here, of course, you don't reach a record when there's hardly any issuance. So issuance was also pretty high, 673 billion last year. The third highest amount, actually. Only 2011 and 2012 saw more of larger volumes of issuance. Again, it mirrors a bit what we already saw with the outstanding volumes. Mortgage cover bonds are the key type that is issued, with public sector cover bonds a little less. And here I think it's good to, it was already mentioned, but I think here you can see that banks needed to rely more and more on wholesale funding last year. And that's also visible in some other slide that comes up a bit later, that more and more cover bonds are publicly placed rather than retained. And we had, of course, last year the Ukraine war starting. We had in July central banks starting the very aggressive pace of rate hikes. Markets were pretty shaky over the year, but cover bonds showed that, it's stated there below, showed that they were a beacon of stability in these volatile markets. So it's for banks very important that they can access funding at the wholesale markets in times of stress, and cover bonds are made for the rainy days. Well, we've seen quite some rainy days in the last 2 years, so and actually a couple of years, and cover bonds time after time proved their strength and made it possible for banks to access funding in wholesale markets, and that's a bit reflected in the high issuance volumes last year. Maybe moving on to the maturity types. Of course, heavily debates in the past about hard bullet, soft bullet, and conditional pass-through cover bonds, but with the implementation of the cover bond directive, a lot of countries have embraced the soft bullet structure with an extendable maturity extension of, say, up to 12 months. Clearly now 62% of outstanding covered bonds has a soft bullet structure, compared to 36% having still a hard bullet structure. So soft bullet is becoming very dominant, and also yeah, investors are pretty comfortable with this type of covered bonds. You don't see a real pricing difference in secondary market. So basically it's a well-established product, which might also be some sign to regulators that will assess the extendable maturity covered bonds. But yeah, if you look at the market, investors, issuers are perfectly fine with these structures. Indeed, next slide I think shows a bit the issuance of soft and hard bullet, and here you can see that the majority of issuance last year, and it's also rising, was in soft bullet format. It should not be a surprise. And as you can see in the blue line, hard bullet cover bonds are on a yeah, slowing path, and that's likely to continue as, like I said, the cover bond directive has been implemented in all EU countries and allowing for soft bullet structure. So the share is only likely to continue to rise of this structure. Then the next slide shows, I think, quite interesting, the switch from of it. It illustrates nicely the switch from yeah, the say retained issuance to public issuance. If you see the yellow bar is private placements, which include also retained covered bond issuance, where you can see in 2020 there was a lot of private placements, which actually mirrored the fact that central banks launched a lot of liquidity lines for banks. They issued retained cover bonds to use these to get yeah, cheap funding at central banks. Well, all these liquidity lines, can also say TLTROs in Europe, in the euro area, they are coming to an end. So banks need to move back to away from, say, retained cover bonds to publicly placed cover bonds. And that was clearly visible last year, where you can see that the increase in issuance was largely driven by publicly placed cover bonds. So issuers need to rely more and more on yeah, real investors again. And now they have been willing actually to well absorb the amount of issuance last year, and this trend actually is likely to continue. I don't see the presentation any longer, but there was another slide which showed a bit of course, the cover bond market is a bit a euro-driven market. Say more than half of cover bonds are issued in euro, but also domestic currencies are important. Say for UK issuers, the sterling market is of course key, and for Australian issuers they do Aussie dollars. But you also see a trend of issuers going to markets which is not in euros and not in their domestic currency. So basically it shows they enter different yeah, markets for their funding, which also shows a bit I think the globalization of the covered bond product, and also the importance of the global markets basically for banks to issue covered bonds. So in a case it bits yeah, adds to the point that covered bonds are such an important funding tool for banks. Now then, this was all about, say, 2022. If we look a little bit ahead to the next year exercise, which is about to start in a few months. Yeah, it will be a close call, because this year, say until half year, until the end of June, we saw huge volumes of this is euro benchmarks of euro benchmark issuance, so above what we saw last year. So that made me already a bit excited about next year's exercise, that we could see maybe another record year. But actually, since the end of the summer, we see a bit of a slowdown in issuance. So the jury is still out where this line will end. But at the moment, we're moving a little bit slower. So we could end a little bit below last year's issuance, but still, it doesn't. It's not the full story. So we could still be on track for a new record, but will be close call, I think, for next year. So happy to discuss this in a year's time. And thanks for the attention, and thanks, of course, everybody for helping out, because maybe that's last line is this is a joint effort of the whole cover bond community to get these statistics done. And thanks everybody for helping out. And if there are any questions, I'm happy to answer. But you can also download the data, play around, and use these statistics. Thanks.
Thanks, Joost. Very much, very impressive, very interesting. So it's me again, but don't worry, I'm just the moderator of the first panel, so I won't be talking a lot. Rather, this is then to my dear panelists. Today I'm joined by Elisa Coletti from Intesa Sanpaolo, Maureen Schuller from ING Bank, and Stefan Dahmer from JP Morgan, who's also chairman of the ECBC market-related issues working group. So first of all, thanks very much to you three guys for taking your time today. Joost, you said that the covered bond is made for rainy days, and rainy days reminds me somehow of the current situation in the real estate market. In my introduction, I mentioned that we are facing a new interest rate environment. We have seen the biggest rate hikes in the ECB's history. And of course, this has an impact on both on the capital market, but also on the real estate market. And that's why I'm very glad to have Elisa here with us from Intesa. She looked at this topic in more detail. And I would like now to hand over to Elisa. Elisa, I think you've prepared some slides. So it's now your turn. Tell us, how has the situation in the real estate market changed? And maybe what are your expectations looking ahead?
So, Sasha, I see that we have some questions. Then afterwards, maybe we can open the floor for questions. From Philippe Terrier, from I think from the Basel Committee.
So shall we? I don't see any questions. So shall we?
Can you hear me? Oh, sorry.
Please go ahead, Philip.
Hi, I'm not from the Basel Committee. I work from the BIS Treasury, so I manage a cover bond portfolio for people who don't know me.
Okay.
No, thank you very much for giving us this presentation and the opportunity to ask questions. It's just a general comment I would like to make as an investor. As just rightly mentioned, the cover bond market has become much more global than compared to a few years ago. And I think it would be very helpful also if it's more a general feeling that I'm expressing. If we could get more, I would say, aggregated data which reflect there is still a long history of being the market being a euro denominated. And it's still I would say difficult as an investor to get global view about supply, about spreads, about the dynamics, which comprise all the new aspects, especially the increasing issuance in dollar or from the new jurisdiction. We still have a lot of segregation in the analysis, I would say, between new jurisdiction, old jurisdiction, and euro benchmark, non-benchmark. And if you look at the market as a whole now, it's very difficult for sometimes to get a clear view of perception of the market dynamics at an aggregated level. So it's just a general comment or suggestion for the future that it would be good also to have some publication which reflect the new dynamics we see in the market. If you see what I mean.
Thanks very much. Joost, I don't know if you want to respond to this or.
Yeah, no, I think it's a fair point. Of course, focus is still maybe a lot on the euro denominated market, but definitely dollar and also the sterling market are quite active. So it is reflect. Yeah, if you look at the breakdown of all the numbers, you can find also these figures to be honest, but maybe we can indeed in the storyline of the stats also focus a bit more on these markets. That could be fine. Yeah.
Maybe
Thanks very much, Joost, and of course, thanks very much, Philippe, for raising this point, and this will be taken into consideration certainly.
Yeah, Sasha, can I just say to Philippe that we have a global brochure that has been produced where we have a focus on the global markets, providing legislative information and also a data set. Now we are currently refreshing the new brochure, which will be published in March 2024. But we have a specific edition, and maybe my staff can put in the chat the link to the brochure to Mark, if you can put the brochure. This is an important piece of document giving us a vision of what is happening outside of Europe. Thank you.
Oh, thank you very much. Very interesting. Thank you.
Right. Perfect. Then next try. Elisa, are you there?
Okay, thank you. Good morning. Thank you for inviting me in this panel. My focus is on the changing the environment for covered bond due to monetary tightening. As you can see here, of course, you know very well the strong and very high and rapid increase in interest rates of monetary policy, and the transmission of this increase to interest rates on loans and on housing loans especially is significant in terms of cost of borrowing for house purchase for new mortgages. The increase in interest rates was 2.5 percentage points from the end of 2021 to August this year, and the level. This is the average for the euro area, and interest rates on new mortgage loans in the euro area reached the level of 3.9%, but in some member countries the increase was higher, and interest rates on new mortgage loans reached a level of around 5% in the Baltic countries, for example. So in general, interest rates on new mortgages are 3 times the one we had at the end of 2021, beginning of 2022. The perspective, the good news is that the perspective is that the general perception in the market, and also the forecast of our colleague in the macroeconomic team is that ECB key rates have probably peaked, and the ECB has indicated that keeping the deposit facility rate at 4% following the increase in September is for long is enough, is sufficient to achieve the inflation target of 2% in 2025. And if a further increase is possible in the event of unfavorable data development, in the sense of a stronger inflation data than stronger than expected, while a cut is possible if inflation forecasts fall sharply. This means that, according to our macro economist, the first decrease in official ECB rates is expected to be next year in September, and the second decrease in December, for a total of 50 bips. These are baseline, of course, expectation. The impact of the very high level reached by interest rates, level which are for mortgages close to the one we had in 2011-2012, so very, very high with respect to the very long period of low of negative interest rates. The impact of this change is, of course, significant to the most interest rate sensitive component of economic demand. And with respect to as regards impacts for the covered bond pool, a significant effect is on the trend in new mortgage loans. I mean, in the flow of mortgage loans, which is, of course, down in most countries. New originations of mortgages decreased by 39% year on year in the euro area in the first 8 months this year. And we have countries which experienced an even sharper decrease of around minus 60%, as in Austria, for example, minus 47% in Germany, minus 40% in France, minus 29% in Italy. But this trend, this decreasing trend, is losing momentum according to most recent data. So it is not the decrease is not worsening in recent months. The other significant impact is on the real estate market, which is, of course, strictly linked to the development in new housing loans, and the impact is in general a reduction in transaction in the residential real estate market, and a decrease in house prices. But development are diversified among countries. As this chart shows, the correction on house prices has been considerable in a few countries, in countries where which experienced a boom in house pricing in the last decade, such as Germany, where house prices went down minus 9.9% in the second quarter this year, or the Netherlands, Luxembourg. Well, they are all experiencing a significant decrease in residential real estate prices. Differently, there are countries such as France and Italy where the trend is more moderate. In Italy, for example, house prices are still up by just 0.7% in the second quarter, but the trend is from stable to slightly up. overall in Italy. And in Spain, again, the prices are still up. So very segmentation in the real estate market across Europe. The other key point with respect to possible impacts on pool of covered bond is the potential effects of very high interest rates on credit quality, and especially on the ability of households to repay their loan, and especially for households more affected by the reduction of real disposable income due to high inflation. And vulnerability in this sense could be higher when depending of household degree of indebtedness or depending on the incidence of floating rate mortgages, where this incidence is higher and where the degree of indebtedness is higher, the vulnerability of households is of course greater. And in this chart you see that there are in general debt to income ratio is not high across Europe, while there are countries where the share of floating rate mortgages over total mortgages is significant, and for example the Nordic country. But the good news also from this side is that following a decade of very low interest rates, the share of flexible rate mortgages decreased significantly in several countries. In this chart you see the yellow column is the share of floating rate mortgages in 2011, so 10 years ago, and the situation in blue, for example, the situation this year following, as I mentioned before, a period of significant decrease in the use of floating rate mortgages. Overall, for the euro area, the share of floating rate mortgages is just 22% in the first 8 months 2023. So this is a good news, because this is a mitigating factor for the ability of households to repay their mortgages. And another good news is that for the moment there are no particular signs of deterioration in the quality of households' mortgages. This chart shows more recent data of the NPL ratio for households' mortgages. The orange column is June last year, and the blue column is June this year. And in order for this chart to be more clear, the blue columns means countries where there is a slight increase in the NPL ratio for household mortgages, and the green column is June this year for countries where we still continue to see a decrease in the NPL ratio for household mortgages. So as you can see, also for countries which experience an increase in NPL ratio, this increase is small. Overall, for the euro area, NPL ratio of mortgages is stable, was stable, is around 1.5%, so very, very low, stable with respect to recent with respect to 2022, but of course this is a low in history overall because it went down significant in the last decade. So overall we can say that the impact for the moment, the possible impact of higher interest rates on covered pool of covered bond, which are mainly composed by residential mortgages, is limited. Due to also thanks to in general to a loan to value which generally offer comfortable buffer, which is loan to value is around 50%, and also for the level of over collateralization, which is comfortable. That's all from my side. Thank you for your attention.
Perfect. Thanks very much, Elisa, for giving us this overview, and thanks very much especially for having two good news at the end of your presentation. The first one is NPL ratios have been quite stable, at least so far. And the second one was that the impact on covered bonds so far is quite limited. That's good to hear. Since Philippe raised the question regarding the global perspective of covered bonds, I would like to look a little bit more globally on the situation. And interest rates have not only risen in Europe but around the globe, and that's why I would like to ask Maureen from ING, how have non-European covered bonds performed so far? What is your view on the global perspective?
Yes, Sasha, thank you. Can you hear me, first of all?
Yes, we can.
Yeah, perfect. If you look at the performance of, let's say, non-European covered bond markets, then I think you see on aggregate a bit of an underperformance. I think that performance should have been expected also in light of the general spread widening we have seen in covered bonds, because generally, if markets are under pressure, these are the jurisdictions that do tend to underperform somewhat. And that is also what we have seen actually since the end of 2021. So ever since underlying yield levels started to rise. However, the performance differences from country to country are quite notable. If you look, for instance, at jurisdictions such as Australia or Canada, spreads have widened since the end of 2021 by roughly 30 basis points. If you look at New Zealand or South Korea, spread widening has been stronger, 35 basis points or even more than 40 basis points. However, if you look at the Singaporean covered bond market, the spread widening has actually been quite muted, only 19 basis points ever since the end of 2019. So to draw a bit of a comparison, if you compare this with the German Pfandbriefe market, the widening has been 18 basis points. So you could say the underperformance on an aggregate spread level for Singaporean covered bonds has been actually more or less in line with that of the German covered bond market. Now, what does explain these differences? That is also quite a bit related to the underlying performance of the housing market in the respective countries. I think the housing price resilience has definitely been strongest for Singapore of the countries just mentioned. House price declines have been more significant. In other jurisdictions, such as New Zealand, but also to a lesser extent, South Korea, Australia, but also Canada. Another element explaining the performance differences, in my view, are related to the supply differences, because countries, particularly such as Canada, they have issued quite a lot. Joost already mentioned it earlier on in his presentation. The significant rise in supply from third countries, and Canada is actually one of the jurisdictions that is mostly responsible for the heavy rise, with 30 billion of supply, for instance, last year, but also in Australia, 12 billion issued in Euro benchmark format last year. And that is comparatively high if you look at the more moderate supply from Singaporean banks. So I think these are the most important explanatory factors for the performance differences in these countries.
Thanks very much, Maureen. Looking a little bit further ahead, a very big issue for non-European covered bond issuers is the so-called third country equivalence regime. Maureen, can you elaborate a little bit on that? What is the situation currently and what can we expect in the future?
Yes, of course, in July this year, the European Commission made a call for advice to the European Banking Authority, among others, to submit a report on a third country equivalence regime and on the design of such a regime. If you look at the call for advice, I think a couple of elements should return in the report. For instance, how should such a regime should be drafted, but also what the impact of such a regime should be on the EU market. The report should look at, for instance, how much European investors invest in third country covered bonds, but also at the other way around. What do third country investors invest in European covered bonds, but also at the performance of these markets. What the outcome will be in terms of the third country equivalence decision is really hard to tell, Sasha. I think all we may know at this point is that the decision will probably be based on a country by country basis, but what the exact what it exactly would look like, so what the countries would have to comply with, that remains still difficult to say. We have done, of course, with the Global Issues Working Group, we have done in the past also a little bit of an analysis to what extent these third country regulatory regimes are aligned with the covered bond directive. And what you see is actually that these legislations are relatively decent aligned, I would say, with the covered bond directive, very strongly aligned even when it comes to the dual recourse, asset segregation or bankruptcy remoteness features of the jurisdictions, but they lack, for instance, 180 days liquidity provisions or provisions regarding extendable maturity structures. It is, as said, it remains tough to see what the outcome ultimately will be, but my personal expectation is that it will definitely have to include some provisions, considering the strict requirement the European Commission has applied to the European member state countries. I don't think we will get to an outcome where essentially none of these requirements would have to be met for third countries to be receiving similar risk weight treatment.
Yeah, thanks very much. So this third country equivalence discussion will certainly keep us busy. for the next 1-2 years, and the ECBC and especially the Global IFIA Working Group stays ready to support the European Banking Authority in its work. So thanks very much for this, but this call for advice that has been mentioned by you comprises also other mandates to the EBA. What other mandates are there, Maureen?
Yeah, so the EBA will actually also make an assessment of the covered bond frameworks, look at the European secured notes, look at extendable maturities, and also green covered bonds and the ESG risks related to the cover pools. I think when it comes to the implementation of the covered bond directive in European jurisdictions, that would fall right under the scope, I would say, of the assessment of the covered bond frameworks, where, for instance, the EBA would look at issuance for volumes, asset collateralization, credit performance of the cover pool, but also the liquidity in the covered bond market, and also to factors such as the extent where the covered bond label is used. Other elements they would look at is at the risk and benefit of the use of exposures, mitigations of liquidity risk, asset encumbrance, and of course they will assess the overall implementation. I think the understanding I would have so far a little bit is that the EBA will definitely not make an assessment on whether the let's say the covered bond directive has been implemented in a correct manner in the different jurisdictions, but they will give advice on whether they see scope for a bit of a reduction in the amount of discretions that are used at this particular point in time in the covered bond directive. But they will also look, for instance, whether certain elements of the covered bond directive maybe need some further clarification on how they should have been implemented, and they would assess actually whether there is a further need for more detailed regulatory requirements. I think if you look so far at the implementation, some first takeaways, what we may expect. And I think that if you look at the ECBC fact book, for instance, but also at the comparative database, but Sasha, also the VDP roundtable covered bond legislations, these are all initiatives, I would say, that offer very valuable input regarding the harmonization that we have seen so far, but also regarding the differences that we have seen in the terms of the implementation of the covered bond directive. I think the whole harmonization process, it was supposed to be a principle-based harmonization, not a rules-based harmonization. So you definitely, despite the harmonization you see across the different jurisdictions, you also continue to see a number of differences, I would say, from country to country. So we have seen, like, for instance, a great harmonization in terms of the introduction of the 180 days liquidity provision. So every European jurisdiction now has 180 days liquidity provisions, but there are still differences whether, for instance, the extended due for payment date is used as reference or the intended maturity date of the covered bond. So whether banks would have to hold liquidity also in the event of soft bullet covered bonds versus the maturity of the covered bonds. There are still quite substantial differences also with respect to the extendable maturities triggers, for instance, with some jurisdictions only allowing for maturity extension in the event of insolvency or bankruptcy or resolution of the bank. Whereas others also provide for extendable maturity triggers ahead of such, in certain circumstances, ahead of bankruptcy and resolution. So there are definitely, many differences still applicable, but it remains to be seen to what extent the EBA will conclude whether such discretion should be removed and whether further harmonization would be required in that regard.
Thanks very much. So maybe it's an interesting information for some of you that EBA will probably not do a complete assessment whether the covered bond directive has been transposed in the right way in each national jurisdiction, but rather focusing on specific elements and ask themselves whether further elements, some elements of the covered bond directives need to have some further clarification. One part of the task for EBA is to analyze the spread development, the liquidity in the market. Has there been a convergence and questions like this? And that brings me to Stefan Dahmer, who is from JP Morgan and one of the most knowledgeable people when it comes to the covered bond market. But before I turn to Stefan, I would like to ask the audience, are there any questions so far on the points we have discussed? I don't see any questions in the chat, and I don't see any raised hands, but I might have overlooked something. So now it's the time to raise any questions if there are any. And if this is 3, 2, 1, not the case. Stefan, are you there actually? I haven't seen you so far. So let's cross fingers. Stefan? No, Stefan Dahmer. That's interesting. Yeah.
I don't see him.
Yeah, Stefan was connected. I think he had some connection issues.
All right.
It may be the case that he will be back soon, probably in the call.
Okay, then we need to have some improvisation. Maureen, maybe back to you, or maybe any other who wants to say something on the question I actually wanted to raise to Stefan. It's about the spread performance and how covered bonds have performed so far and what the driver for covered bond spreads have been so far. For instance, whether the covered bond directive itself had any impact on the spreads at all. Maureen, I don't know if you want to elaborate on that a little bit, and sorry that we haven't spoken about this before, but...
No, it's absolutely fine. Well, I think getting to your general question, what has been the biggest driver to covered bond spreads in the past years? I would say the past 2 years is the rise in the underlying yield levels. You have seen actually with the rise in the underlying yield levels, you have seen covered bond spreads also becoming subject to widening pressure. Of course, here you have seen differences from country to country. I think underlying sovereign risk is one of the explanatory reasons for the performance differences. But also particularly if you look at the relatively strong performance of lesser underperformance, I would say, of the German covered bond market. I think also the underlying Bund trading levels have remained for this particular market. They have become less constructive maybe, but they have been definitely been one of the reasons why this market has continued to show relative performance resilience in comparison to the other jurisdictions. Where it comes to the implementation of the covered bond directive, whether it has a visible impact on the performance of covered bonds, I think it's difficult to argue yes. I would say there are two examples I could make. One of them is related to Finnish covered bonds, probably, because here we have seen actually that issuers have set up new covered bond programs under the amended covered bond regimes versus covered bond programs. All the covered bond programs that remain still in place and that comply with the old covered bond regime. In fact, what you see here is that if you look at the bonds that are issued under the newly established programs under the new covered bond regime, you see that the trading levels are a little bit wider even. So that is one example showing why it's difficult to argue that the covered bond directive has been favorable to performance, because also there are differences in coupon levels that result in higher asset swap spreads for covered bonds that are issued after the 8th of July 2022. The new issue premiums have risen quite notably, and part of some of the new issue premiums have not yet fully converged. So that is one example where I don't really see a positive impact of the implementation of the covered bond directive. Another good example, in my view, is maybe the conditional pass-through segment in the Netherlands. Also here, we see that of the publicly outstanding conditional pass-through programs, they have not been converged into under the new law. Many of these issuers have set up soft bullet programs. 3 of them have by now also converged, let's say, their existing conditional pass-through programs into the soft bullet covered bond programs. But here you see actually the conditional pass-through covered bonds that are still outstanding. They trade flat in line with the soft bullet covered bonds of the issuers that have still a separate CPT and soft bullet covered bond program, despite the fact that the soft bullets are issued under the new regulatory regime. So in my view, this illustrates that in a way the covered bond directive has been of lesser importance to the performance of covered bonds. In the case of the conditional pass-through segment, I would say it's mostly the market anticipating that also by means of a constant solicitation, these bonds will be morphed into the soft bullet programs at a later stage.
Thanks very much, Maureen. Excellent that you stepped in. And I see now 2 questions in the chat. I started with the second one because it's concretely referred to you, Maureen. And it's about extendable structures, because you've mentioned that some extendable structures are applicable ahead of a bankruptcy or resolution proceeding in some jurisdictions. So the first question is, can you name some of them? And furthermore, does this pre-bankruptcy extendable structure favor issuers of that jurisdictions in the view of investors? So first question, in which jurisdictions you can make use of the extension before a bankruptcy? Second question, what is the view of investors in that? And the third question then related to investors, how has investor distribution of new covered bonds has changed since the rates have increased? And are we see many new investors? So that's slightly different angle, but maybe first 2 questions regarding extendable structures.
Yeah, regarding extendable maturity structures, I think, for instance, the Netherlands is one of the countries where you could see maturity extension taking place before an issuer event of default or a resolution event. That would, for instance, occur if the issuer is unable to fulfill its redemption payments on the covered bonds. In that regard, of course, the covered bond company would become liable to meet the payment obligation under the covered bond program. And then you could see maturity extension if the covered bond program, if the covered bond company, for instance, of the first maturing covered bond would not be able to make such a payment. So here is an example, I would say, of a jurisdiction that can apply maturity extension ahead of issuer insolvency or resolution.
Sorry, Maureen, if I may add here, I think very important is to always keep in mind what covered bond model we are talking about. For instance, if you look at the French covered bond model, where you have a full special purpose entity issuing covered bonds, so having nothing other on the balance sheet more or less than the cover pool, it certainly would be too late to have the extendable maturities after this issuer's insolvency, because then it's about the cover pool that is already insolvent. So in my view, you always have to look what covered bond model are you talking about and dealing with. Sorry for adding something here. Maureen, back to you.
Yes. Could you please repeat the second question?
The second question was actually, if I understand it correctly, how do investors see this possibility? Do they like it or don't they like it? Can you see any impact here?
No, I think also, Joost, you already also mentioned it in your introduction. If you look at the issuance of soft bullets and you compare it, for instance, with programs that have still hard bullets covered bonds outstanding, you hardly see a trading difference. I think there is also in this regard, it is very difficult to argue that these are differences that really lead to substantial differences or substantially are impacting covered bond trading levels.
Yeah. Okay, and maybe just to add the final question before we hand over to the second panel, that was about investor distribution of new covered bonds. Has this changed as rates have increased, and are we seeing many new investors?
Yeah. I think if you look at the distribution statistics for primary issuance, then I think one of the most important observations here is, of course, the removal of the central bank demand and where you have seen the biggest replacement. I think what you see if you look at these placement statistics is that particularly the allocations to bank treasury accounts have increased drastically. Again, I think there are definitely some investors that have felt that covered bonds were trading at too low yield levels or too tight in asset swap spreads, that they have in a way returned to the market. But I would say the most notable observation in my view is the fact that we have seen before the CBP3 crowding out most of the bank treasury demand, that now the CBP3 is gone from the market, that actually you see there that the biggest allocations have been again. And of course, with the focus on the shorter maturity buckets, I would say that the distribution to pension funds and insurance companies that traditionally participate more in longer maturity supply has also been a little bit less.
Okay, wonderful. Thanks very much, Maureen. Thanks very much, Lisa. It was great to have you here. And Andre and Richard, I hope the answers to your questions are satisfying. I would like to give you a big applause. It's very difficult to do it virtually, but thanks very, very much. And with that, I would like to hand over to, here we can see some virtual applause. So perfect. Thanks very much. Now I would like to hand over to Stefano, who will be moderating the second panel with its panelists. Stefano, the floor is yours. I hope that Stefano is on the line, because I think I already saw him. Stefano?
He's here, I see him. He can't speak.
Good news.
He's looking to just to make his speakers work, I think.
Stefano, if you don't mind, I can already mention the panelists you have on board to bridge the time. If this is okay.
Yes, Sasha, please go ahead.
Okay, so we have Sabrina on board. Sabrina Mies. Then we have Sana, and I already saw Sana. And finally, we have Sander as a panelist. for the next panel. So maybe you would like to introduce yourself very briefly, and then we hope that Stefano will be on board and has solved his technical problems.
Okay, Sasha, shall I start? I don't know if you can see me. Actually, my camera is going on and out. I don't know. Yeah, but you can hear me, obviously.
I can hear you. I can't see you.
Okay. Yeah, I try to restart the camera in a second, but I can present myself maybe quickly. So my name is Sabrina Mies. I'm from Helaba, heading the FI and SSA research, and I'm very much focusing on the advisory side of sustainable finance with a focus on banks and entities from the public sector. Thank you.
Hi, everybody. Can you hear me?
Yes.
Yes. Yeah. So my name is Sandra Eriksson. I'm the CEO of OP Mortgage Bank, which is the covered bond issuing entity of OP Financial Group, which is the biggest banking group in Finland. And I'm also the head of IR. So nice to see everybody. And it took me an hour to get into this meeting, so I really wanted to come, but I guess we had the same challenges with Stefano. So hopefully he'll be here in a minute. And now we can at least see Sabrina. Hi.
Yeah, we can see you. Wonderful. Thanks very much, Sana. And finally, Sanda. And sorry if I didn't pronounce your name correctly. No, Sanda. Okay, we are losing more and more panelists, moderators. It's going to be very interesting. But since
we have to reconsider, Sasha, if you don't mind, the WebEx as a platform, because I mean, we moved from Teams to WebEx to make someone happy, but I mean, I think I have to say we have lost most of the people to make a couple of people happy with WebEx.
Luca?
Yeah.
Can you hear me now? Can you hear me now?
Okay, we're fine.
Can hear you.
Yeah, welcome.
Okay,
Yes.
well, finally. All right. You pronounced my name quite all right. My name is Sander Roling. I work for NN Bank in the Netherlands within the Treasury Department, responsible for wholesale funding, and that includes cover bonds, but also green bonds, and responsible for the green bond framework.
Thanks very much. And since Stefano hasn't shown up yet, I do my very best to try to moderate you three guys a little bit. But again, since you are profis, you are probably better by your own. I haven't been involved really into the preparation of this panel, but I know it's about sustainable finance. That's for sure. And I know that when it comes to sustainable finance, that definitions always are very important. And if I'm not mistaken, you, and I think it's you, Sabrina, I don't know, you want to elaborate a little bit on the topic of definitions, right?
Yeah, I'm just setting the ground so everybody is on the same page. So we are talking about social, green and sustainability bonds. And when we talk about those bonds, it's obviously good to know again what we are speaking about. So social bonds are bonds where proceeds are exclusively applied to finance or to refinance social projects, and the same is for green bonds. So green bonds are bonds which are where the proceeds are exclusively applied to green projects. And well, with the sustainability bonds, they are a mix of both. So the issuer can choose and has a basket of social and green projects where the proceeds are applied to. That's actually it. And I think it's well used in the market, and the market standards, and we come to this in a minute, I guess, are based on the ICMA principles, which are setting the ground for these definitions.
Yeah, the ICMA, ICMA green bond principles, very important. I hardly know any issuer who is not referring to the ICMA green bond principles or social bond principles. And ICMA has changed, or not really changed, its requirements and definitions, but they are making now a difference between certain types of green bonds. And if we focus on green bonds first, then And maybe Sana, was it you who would like to say something about the new different types of green bonds according to the ICMA green bond principles?
Well, actually, what we were planning on discussing was more of the change, because of course, as everybody knows, the where it all started was with the ICMA green bond principles, and that has become a sort of a market practice with the green bonds. But then, of course, we've been dealing with EU taxonomy in the many years already. At least it feels for a long time. And now, as a newcomer, we have the EU Green Bond Standard focusing directly for the green bonds. But if we look at green covered bonds, I don't see that the EU Green Bond Standard gives us so much that we probably, at least from myself, in my personal view, I kind of waited for the new standard and see how it goes. But it seems to us as well, for the first readings and not for the whole thing, I have to admit on that. But what comes to mind is that what we've understood is that it was supposed to be like this golden standard, but it seems to me that it might be even a diamond, or I don't know, platinum one. So the question is are our bonds good enough, and how can we is there actually going to be the issuers that can be able to issue their green bonds under the EU Green Bond Standard, and if so, can they do that frequently? Because at least from my point of view, I see the green finance as a challenge for all of us issuers. You started with saying that there are over 300 covered bond issuing entities in the market, and how much of those are able to issue green in the first place is the big question. And then it comes to that you can do that frequently, not just the one kind of prime jewel that you can do. And in that sense, I think, in my opinion, is that what we've been, and when we talk with the investors, it comes more to the investors what is green enough for them, and not targeting the like the most darkest green possible products, but just to find out with their own standards, kind of what is green enough for their portfolio. And if we look at what we've heard from the investors is that they even might have already or are planning to have this kind of target percentage of their portfolios what should be eligible for the EU Green Bond Standard. But that's only you're talking about 10 or 20% or something like this. So in general, the demand is to have more green issuances, and the next part of that is which principles or standards, and there the ICMA is still number one. And of course, if and when there are more issues online, if someone wants to interfere and talk about their views, please feel welcome. But yes,
in essence, I do agree with you. I also see the EU Green Bond Standard will most likely coexist next to the ICMA Green Bond Principles. It will not take over, as simply the most issuers are not able to align with the EU taxonomy, at least not all of them. But when you look at cover bonds, I would say that, especially for the cover bond market, I would say that the EU Green Bond Standard will be adopted as, when you look at the EU taxonomy, it is still in development, but for green buildings, it is already final. I mean, the practicability, that could be better, in my opinion. but at least mortgage providers should be able to issue EU green bonds in time. It is just that what you also state that, well, you have 300 covered bond issuers in Europe, but there is just a small number of issuers that actually issue green covered bonds, and that is also to do with well, how much of your assets can you identify as being green, and the EU green bond standard will definitely not help there.
Unfortunately,
it will not make your green asset pool any bigger, and some other issuers choose to well, basically use their green powder to or green assets to issue green unsecured, as there's a bit more pricing power in there with green.
So if I understand
definitely true.
So if I understand, sorry, Sana, but if I understand you correctly, that the message is, in theory, covered bond issuers could use green covered bonds that are in line with the green bond standard. However, given the complexity of the taxonomy requirements, it cannot be expected that plenty of covered bond issuers will then issue all of a sudden green bond standard aligned green covered bonds. But if I understood you, Sana, correctly, the question you raised, the answer to this question, what do investors consider green? The answer is not that all of the investors require EU taxonomy compliance. Is this correct?
Well, yeah, it depends, and of course, if you, well, I can only speak for my own behalf and from our bank, but if you look at our green covered bonds, they are double green in a sense that the cover pool there is the amount of the loans as collateral that are green, and so the use of proceeds are the green houses and buildings that are lying as a collateral for the mortgages. So in that sense, there's not much, like Sanders said, the flexibility pocket does not apply here because EU taxonomy states clearly what are green mortgages, and there it comes for, I don't know, the customer data, which is the challenge, and there's no standard helping us to get more data and to get more green assets besides of getting the EPCs ready and having more and more intensify the people to actually get the EPCs for their houses and to make the renovations and so on. So it's a lot to do with the transition to become more energy efficient in that stake.
Yeah. So why we have on the green side, why we already have there the taxonomy and we already have the green bond standard, the situation on the social bond and social covered bond area is completely different. We have no EU taxonomy, social taxonomy. We have no social bond standard from the EU. Turning to the social part, social covered bonds, what is the potential for social covered bonds given this different environment, and especially when it comes, for instance, to local public sector investments? And I mentioned the social taxonomy. Do we have to expect a social taxonomy soon? So let's turn to this whole subject of social covered bonds, and I think, Sabrina, it's first of you.
Yeah. Well, if you look at the local public sector investments, they are really huge in the EU. I think we had this number in 2020, about 300 billion euro, and thereof 120 billion with social objectives. So as such, I would say there is a potential. If you look just at the pure numbers, So investments in public education, public housing, healthcare, infrastructure. But obviously, we don't see so many public sector covered bonds, right? With social covered bonds. And there is one thing that we need to see, which is that typically local public sector entities finance their overall investment budget. That's traditionally the case. They don't really identify specific projects, investments, and just finance them specifically. So that's an issue we have in this segment. Nevertheless, as we can see, the market is growing. We have even had, I think, quite a few. We had nine issues this year, which is quite good compared to 5 issues last year, almost 8 billion. So this market is growing. There are more and more solutions, or there are more and more possibilities for lenders to identify these loans and to finance them via covered bonds, which is a good message. Nevertheless, I think it could be much more. And here, the entities and the lenders have to adjust their lending processes to be able to identify even more of the social investments coming from this segment. You're speaking of social taxonomy. We know there has been a final report from the Platform on Sustainable Finance last year, in 2022. And now we are hearing, in summer, we heard quite a few statements from the EU, from the head of the sustainable finance in the COM, Mr. Spolk, who said, no, they are not actively working on it. It's probably unwise at this point to work on social taxonomy. And we had a confirmation by the head of the EU Platform on Sustainable Finance, Mrs. Fiestas, who also said the Commission is right to drop plans for social taxonomy for now. Why is that the case? I think it is because they have so many other things on their desk, right? They are thinking about the green taxonomy, more interpretations, more expanding here. They have the whole sustainable finance package, regulation on ESG ratings on their desk. And the platform itself is now working on transition finance, which is really much demanded from the industry. Rather than looking at the social topic. Nevertheless, it's important to have social standards. It's important for the investor confidence. And we are obviously happy to have ICMRA again. They updated their principles this year again with regard to target population. A few requiremements have been updated also with regard to transition finance into that. The impact framework has been updated. So at least we have a good basis here, a good standard that is developing based on market practices. And on the other hand, I can tell you that I've read, I haven't secondary research, I've read that there are 2 groups in France and in Germany, investor groups that are continue to working on the social taxonomy. So there is investor demand for these standards. So on the French side, there's a group of EXA, HSBC, La Banque Postale, a former member of the Platform on Sustainable Finance. They're working on an approach and building on the social taxonomy final report from last year, but they envisage a new approach, as I understand. And in Germany, we have an investor group as well that is working on refining the social taxonomy from last year, refining the structure and the content. And my understanding is they call it the social framework because they understand and realize going to the Commission now with the taxonomy nomenclatura is a bit difficult. So but they're very eager to come up to have a social framework, because if you think as the FDR, the regulation for the asset managers, there are some social elements, but social objectives are not really defined. So investors need a framework. They need something like this. And so there is movement, there's development in this area, and we are observing this.
Thanks very much. And there's actually a question regarding the SFDR. and we are talking about the reporting requirements in a second. But my spontaneous idea is to raise a question to the overall audience. And if you would say yes to my question, then please raise your thumb. You can do it here in WebEx. So here comes the question: who is in favor of getting an official EU social taxonomy? If you are in favor of an official EU social taxonomy, please raise your thumb. I can see no single thumb. So maybe I'm either no one. No, there's one. Michael? Yeah. Michael? Do you see any other thumbs?
Probably the challenge might be that from in the social side, there's if there are not that many issues issuing green, there are even fewer that issue the social one. So I guess well, at least for me, I don't have an opinion because I don't deal with them. So I guess that might be a challenge for my colleagues as well. Or
Yeah.
then everybody is in favor of saying no, but of course then you can just raise your voice and tell.
I have a clear view on this, but since I'm just moderating here, I'm on the sideline.
Please
so
go ahead. You're a guest also, so you can do it if no one else will raise their voice.
No, maybe I can raise my voice, but I was also doubting what to vote. But then I thought, well, indeed, with the social territory, it's of course much less tangible than the green angle, where you can measure CO2 emissions of buildings, etc. With the social, you can end up in like an it's a very open debate what is social, and opinions can be very much divided. So on the one hand, you would say yes, would be nice to have a taxonomy that says this is what we see as social in the EU. On the other hand, it will maybe be very complicated to get to this solution, and then getting there will lead to all kinds of conditions and more rules, which make it basically not workable in practice. So I think that's why I stayed away from raising my hand.
I like your comment, Joost. Okay, thanks very much. So as I've said, there is a question regarding reporting, and this is referring to the SFDR, so the Sustainable Finance Disclosure Regulation. And the question from Richard is, does the requirement in the SFDR for investors to report which article they conform to and concerns about greenwashing mean that non-taxonomy compliant covered bonds become second class? So this question refers more to the green side rather than to the social side, but that's still a nice bridge to the reporting requirements we are talking about in a second. So who wants to answer this question, become non-taxonomy compliant covered bonds second class?
Well, I'm not sure what is non-taxonomy compliant, because of course, as at least what my framework says is that we are aligned on a best effort basis. Because back then when we wrote the framework, it was not sure what the taxonomy is all about, and I'm not sure if it still is. So in that sense, I think it might be that in the future. But on the other hand, we have so few green issuances, so I guess there's a bigger demand. So there are, even though if there would be some investors not wanting them, I guess that in the other side there's not that much supply for the ones, at least for now. Of course, it will change by time, but it takes time. And one thing I am also wondering is that the first green covered bond that we issued, it was 10 years, and now when it talks about 5 years in the taxonomy and in the EU green bond standard, 7 years grandfathering period. So I think that is one thing that we could also discuss is that do we see that there are well, of course, for now it's not a problem because we go for the shorter end, but in the future there might be a chance that we will want to issue longer ones. But is there a demand for longer or maturities than the 7 years?
Sabrina, Sander, you want to add something?
Yeah, I would also agree. I guess it's a bit a timing issue. So currently, there are a lot of Article 8 funds, right? The nine funds are not that numerous. We remember that a lot of them have been reclassified last year, and a lot of other investors even haven't come up with Article 9 funds. So I'm not too sure if that distinction that covered bonds do not yet or may not yet fit into Article 9 funds is that of a topic at the moment. I think it could be a topic then the more we see compliant products for Article 9 funds, but covered bonds will develop as well in that time. So I wouldn't panic. Let's call it.
I do see added value from the EU Green Bond Standard here, as the EU taxonomy alignment is then evidenced. But you'll already see this currently as well in existing frameworks and second party opinions. Some even with exact figures, giving the same comfort to investors, I would say. So I don't see a second class of green bonds there.
At least as long as there's no different regulatory treatment, right? So when we might end up in a situation where you have a different regulatory treatment, for instance, regarding, I don't know, green supporting factor, brown penalty factor, things like this, things might be different, right? Okay, so we've already touched a little bit on the reporting side, and there's, I mean, you all know that banks, and not only banks, are faced with an extreme bulge of reporting and disclosure requirements when it comes to sustainable finance, and that's why we do have a specific article in the Covered Bond Factbook on reporting and disclosure requirements. And I think it's you, Sander, who could elaborate a little bit on that. So please.
Yes, I think when it comes to the CSRD, that's the Corporate Sustainability Reporting Directive. Well, most importantly, that paves the way for establishing a European sustainability reporting standard, and it integrates sustainability reporting in the annual report. And companies subject to the CSRD will have to report according to the European Sustainability Reporting Standard, which is then based on a materiality assessment where only material impact, risk, and opportunities need to be disclosed. However, it also contains certain mandatory disclosures which companies need to provide regardless of whether these are deemed material or not. It is quite challenging, and the challenges are widespread, I would say, but mainly in the complexity of the reporting and data quality. CSRD introduces detailed and extensive reporting requirements. Gathering, verifying, and reporting the required data, especially for organizations with complex operations, can be challenging. And ensuring the quality and reliability of reported data is crucial. And organizations need to implement processes to ensure the accuracy of their sustainability data.
Okay, thanks very much. I like the thumbs up and down function here. So here comes my next question spontaneously. Who thinks that we, and by saying we, I'm referring to, actually both issuers, so banks and also investors, that they are facing too many disclosure and reporting requirements. So who is in favor of this statement? Thumbs up. Too many reporting disclosure requirements. Again, I don't see any thumbs. So maybe that function doesn't work. So let's turn the other way around. Who thinks that we need more disclosure and reporting requirements when it comes to sustainable finance? So I saw you, Sana.
Yeah, the challenge probably at this time is that it just takes so much time for to gather the data and internally, and then could have it harmonized as a whole. So I guess that, of course, I don't think that anyone can say that we have too much, but we probably agree on that there's a lot of effort to fulfill all those requirements, and also at the same time to build up the products and offer the investors the products that they want. But also one thing comes to my mind is that in general, when we talk with the investors, it's not only the green products or the sustainable products that they are after. They are looking at the whole entity or the issuing entity or the group and how sustainable it is, and all with all its functions. So in that sense, it's a challenge for the issuers in itself, that it's not only producing these green or sustainable products, it's the whole picture of making the entity more sustainable, and there of course how you can prove it is by measuring and reporting. So in that sense, I truly understand that side, but not need of more. That's what I can say.
Yeah, all right. So you raised a very important point, that is the whole entity that need to fulfill some certain sustainable requirements from investors, because that brings me actually to the topic of ratings, sustainability ratings. So we do have sustainable ratings for specific issues, right? Second party opinions on specific issues, but we also have a huge variety of sustainability ratings referring to the whole entity. So what is the relevance of sustainability ratings in your view? And Sander, I don't know if you want to take this question first.
Yeah, that's fine. Maybe one more thing to add on the reporting side, because there's also quite an interplay with from CSRD with other EU legislation, such as the taxonomy, the SFDR, CRR, Pillar 3, and CS due diligence directive. Because companies that are in scope of CSRD, they also need to provide disclosures under various other regulations. And then it comes down on disclosure of ESG strategy, targets, KPIs, etc., including assurance from the auditor to enhance the greenness, comparability of companies, and to minimize chances of greenwashing. And the information gathered and reported under the European Sustainability Reporting Standard is also relevant for other regulatory initiatives. For example, financial institutions can use the reported informations to disclose the principal adverse indicators under the SFDR, and report also on environmental impacts under the Pillar 3 of the CRR. So it's quite you basically have a whole circle of information and disclosures under the various regulations to give a complete picture of where you stand as a entity with regards to ESG from multiple angles, so to say. And then with regards to ESG ratings, well, at the moment, I think sustainability ratings are an optionality for issuers. They are not yet on the same levels as credit ratings. The big investors usually have their own ESG scoring methods, as ESG ratings can vary quite significantly across agencies. And this doesn't mean I don't see any added value of an ESG rating. Because it can tell you quite a lot on where you stand with implementing your ESG strategy. It discloses strengths and weaknesses, which can help you to further develop the strategy, products, services, etc. So it can also speed up internal processes. But when ESG rating agencies have to be registered with ESMA and their methodologies need to be made public, it could potentially add weight to the ratings, and also I do expect some convergence in rating scores, which should enhance the practicability for investors.
Yeah, very good point. I'd love to raise another question, thumbs up, thumbs down, regarding the impact of the regulation for ESG rating agencies, but given that time flies, and I don't want to bore you with all these questions to the audience, I would like to go to the next and last topic and ask all of you, three guys, about the HTT, since the HTT has, the ECBC's HTT has a specific tab for green assets or for ESG assets. What's your view? How relevant is the ESG tab in the HTT for investors when it comes to sustainable covered bonds?
I would say it is very relevant. It is also your willingness to show and to demonstrate the greenness of that part of your cover pool. It is quite difficult to fulfill all the stratifications, as not all data might be available on a regular basis. But if you issue green cover bonds, then for investors, I think for them it's more than welcome to receive green data on these green assets.
Anything to add, Sana?
Definitely agree with Sander, and I am sure that it is a step towards the right direction, and it shows the willingness of ECBC to be in the front line rather than waiting in the back. What will happen? So it is really good, and it's also, like Sander said, it is challenging to fulfill, and in that sense, it kind of sets up the bar a little bit higher for all of us issuers to work to get the data and to be able to report, but really in favor of that.
So thanks very much, ladies and gentlemen. A big applause to my three panelists, and especially thank you very much for dealing with the moderator who was not really involved in the preparation. So you did a fantastic job, and maybe a big applause to the three panelists as well here. And with that, I would like to hand over to Luca for some conclusional remarks. Luca, the floor is yours.
Thank you very much, Sasha. I mean, allow me to thank you on behalf of everyone for managing the situation in such an elegant way and to help us all to fix the problem. I think that we have Stefan and Stefano both on the line that are listening to us, but they cannot turn on the bottom mute, which is apparently a big problem. Sorry, so apologies for all of you. We tried to make it easier with WebEx, but it was not the great idea. I mean, next time we will reflect on maybe moving on Teams for everyone. But I mean, what we have seen today, Sasha, it was an important, I would say, fresh up of the information. The fact book is a valid information of the last year, and with this webinar, we want to give a fresh touch of where is the debate, where the market is moving, what's going on, and what are the voice of the expert. This is a community done of experts. All of us are shaping the industry, and as Sana, you said, we are moving ahead. We are always proactive, and in the steering committee, we try always to anticipate the regulation to make the life of our banks a bit smoother and easier. We know how difficult it is to move in this environment where geopolitical risk, such as you say, is on our shoulders, but the covered bond remains a crisis management tool. It's a way how banks can manage crisis, climate crisis, geopolitical crisis, giving hope to people in a better house, in a better future, in a better system. So that's why I firmly believe that financial stability is built on hope of people, and we are all working together from Tokyo to Vancouver, passing via Dublin, to build a new system. And we remain fully committed to this. And the fact book is, I think, the best expression of this community, willing to give a strong message of hope to the market, investors, lenders, and regulators. With this, I would like to thank you all. We are already preparing the new fact book. I think, Sasha, we will be discussing this in January. The working group meeting will be meeting in January. Let's hope in person, Sasha. I don't know what you think, but I mean, maybe we can try to re-go back to the old-fashioned system where we were meeting in Brussels, but let's try to see what is the most efficient way. But don't miss that appointment. I see Stefano, that is appearing from nothing. I don't know if you can speak, but I mean, I see Stefano now appearing. But thank you all. Buon appetit. I think we are 3 minutes ahead. I don't know if Stefan and Stefan can say something, or they want to try to say something.
I have finally succeeded in, after switching off many times my computer off and on. So apologies to all the panelists, but you made a really great job, and Sasha, perfect. So thanks a lot. It's been very, very interesting, and apologies again for not having been there at the right moment.
Thank you, Stefano. Someone is asking, I mean, Philip, I think you are asking for the slides. I think, Edo, that we can share the slides with all the participants. So you will receive this with a thank you email for the participation. Thank you all. And Perfect. As I said, bon appetit to all. And thank you again, Sasha. You were the magic star of the day. So thank you very much.
It was a pleasure. Thanks very much.
Good job.
Have a nice day. Bye-bye.
Bye-bye, everybody.